I'm John Millican. May I again introduce Michael Hughes, who's a special economic advisor to Fiducia and also the consultant to our investment team. Michael's exceptional knowledge and experience are of tremendous value to all our clients, and that's why we thought you would like to hear his views firsthand. Michael, thank you for your time and your insight once again. In January, you gave us your views on 2010 and the prospects for 2011. Since then, we've probably had more events, economic, political, even geophysical, than we could probably imagine when we were talking in January. At that time, you said that investors needed to be careful after a good 2010, and you said the watchwords for 2011 were capital preservation. Is that still the case?
I'm afraid it is. If you think back to December of 2010, stock markets went up about 10%, and there was a mood of reasonable optimism going into this year. But there were three quite important things always to bear in mind. The first was the amount of debt that had built up, particularly in the US and the UK, and at some stage that had to be repaid. You then had the problems with the euro, which clearly were not going to go away. And in addition to all that, you had the prospect of emerging countries, particularly China and India, having to tighten their monetary policies, raise interest rates, to calm things down in their economies. So against that particular backdrop, it seemed to be pretty unlikely that you were going to make many gains in 2011. And many of those factors are still in place. And on that basis, I think capital preservation and a low level of risk-taking is still appropriate.
What will be the signs when that scenario changes from an investment point of view?
Well, I think the things I'm watching are threefold. The first is when you start to see places like India, like China, reduce their interest rates and basically give a stimulus to their economies. And they'll do that when they think the inflation fears in those economies are past. That may not be far away, given what's happening to inflation in that part of the world. The second, a more difficult one, is when the whole euro position is going to be resolved. And that is a particularly difficult one, because nothing clearly is going right there. And indeed, it seems to me that the European authorities are almost echoing the mistakes that were made in the United States in the early 30s by pursuing the wrong policies for the wrong reasons. When those policies change, and you may have to have a very different makeup to the euro for that to happen, then I think we can start feeling that the European risks are diminishing. And the final one, in terms of the Anglo debts that we're having to deal with, I think we are dealing with those, but frankly it's time rather than policy that's going to be the answer there. People have built up debts over many years. It's going to take them many years to actually get those debts under control. They have started, but I think we're looking out over a good 3 to 4 years further before that situation has been stabilised. So that's not a negative, but it's not yet a positive. And the other two, one could be a positive later this year, but one I think is actually going to be a bigger negative than before it turns into a positive.
Am I right? It seems to be that we're in a situation where there are two potential solutions pulling in opposite directions with all of this. One is to reduce debts, and the other one is to achieve growth. And I don't quite see how, looking for your insight, how that conundrum is going to be solved.
It is a very difficult balance, and I think the real danger in some of the European states at the moment is that they are now in a debt spiral. Greece is a good example, where because the economy has collapsed, tax receipts have collapsed, and they're having to raise more taxes in order to meet their obligations to external supporters. Well, that actually is going to push the economy further down. They very definitely have a debt spiral, and it's not unique to Greece. You're seeing it elsewhere in Europe. The UK's situation is different. We've actually got a situation where big companies, and I emphasise big, actually have reduced the gearing in their balance sheet, accumulated a lot of cash, and they're financially very healthy. Individuals clearly have a lot of debts to pay off, and whilst the government is pursuing an austerity programme, which incidentally I think will last 2 terms, not 1, given the size of the problem they're dealing with, then it's very unlikely that we will see consumers being off to the races as they did a few years ago for quite some time. So the hope here is that the balance between those three parties will leave companies coming through, but that still suggests that growth is going to be pretty subdued, and actually it's not going to be a very lively time for some while.
And is the issue also in all of this that not all countries can follow the same policy, or it's not helpful that all countries follow the same policy at the same time, that there has to be some leaders in terms of the path out of all of this by reflating their economies, reducing interest rates sooner than others that simply can't afford to do that.
I think that's true, but equally you might think that global companies, and many companies are now global, in some cases some of them are as big as individual economies, if they start investing in the future, and they may have to have tax incentives in order to do that, but you may find that they actually come through. This is actually what happened in the 1930s. And although we started the 1930s in a very difficult situation, really it was a depression, actually the stock market began to recover well before the economy began to recover. And the hope, obviously, is at some stage that will also happen again now.
Thank you. Right. In that, you touched on the issue of sovereign debt. Particularly with regard to the developed markets, which is where the concern is. Easy question. How and when do you expect those sovereign debt issues not just to be solved, but if you like, there to be a blueprint which is agreed that's going to take everybody in the right direction?
I fear that the solution in Europe is going to be one of some countries defaulting. And whether that means the breakup of the euro is debatable. But I think the situation as we currently have in September is unsustainable. And you can clearly see there are great political rifts. In fact, you've now got a balancing act between what a liberal democracy will accept and what external creditors are trying to impose. And something will therefore have to give. So it may be that we're only a short time away from this European thing seemingly collapse, but on the back of that collapse, there will be a new order, cheaper values of assets, a lot of pain, not least for the banking sector, but actually something that you can rebuild with, as opposed to trying to continue with the current story, which is getting nowhere fast.
I mean, there is this sort of almost version of Parliament now, isn't it? The first country that's going to leave the euro begins with G. But which letter does it end in?
Well, that's a good question. And there is a debate, frankly, about whether the euro should split into two units and have a strong bit and a weak bit. But frankly, that's a hard one to call from an investor's point of view. The one thing which I would still be anxious about is that whilst you have this impasse, the degree of the pressure on the European economies, and hence on the UK economy, because our major trading partners, will intensify. The longer we wait to get the situation sorted out, the bigger the pain will be. So the sooner we can get to grips with it, the better. And accept what pain is currently coming our way, largely to the banks, but not exclusively.
And given the events over the past few days, does it appear now as if Germany is almost pushing Greece towards a hard default by obviously the resignation of the German representative on the ECB and other comments that have been coming out to the effect that almost they're admitting there is a plan B?
Well, German politics is coming to the fore, and they're saying, well, we're already paying for the bailout of Eastern Germany. That's 20 years ago. The last thing we want is to actually add to that bailout fund for some of the South European states. So I think Germany's probably said, we've had enough, we now want a different order.
Thank you. So finally, given all the foregoing that we've talked about there, what asset classes should investment managers be focusing on certainly for the foreseeable future?
Well, the two things I would look to are large cap global equities, the large companies, because they are the ones that are financially sound. They are the ones who potentially have already got the dividend covered for a while, and where the valuations do not seem particularly extreme. So going into global equities at the appropriate time, I think, is one of the things that we're looking to do. The other thing is the emerging markets, because although they're deemed to be high risk, actually relative to the developed world, they actually currently contain fewer risks. But there's one caveat to that. People have looked at the emerging areas as a whole and said, well, they're overtaking the developed world, they are the future, let's invest in them willy-nilly. Actually, I think you will find that investors will be differentiating between different countries in the emerging bloc more than they have in the past. And the reason I say that is that some of the inflation problems in China aren't going to go away quickly. There is a property bubble there. Some of the valuations you have in Russia are very low indeed, virtually half the equivalent in the developed markets for equivalent companies. And you look at places like Brazil, like India, where the demographics are much more favourable than some others. So I think people will be differentiating by country in their emerging exposures more than they have done in the last few years. And looking to take advantage of those opportunities is part and parcel of rebuilding the risk profile in your portfolio.
So what are you really suggesting then? It's a matter of sort of regional allocation. All of those presumably.
I think it's more country than regional, to be honest. I think even within regions, I think you can pinpoint particular countries within the emerging bloc that you would want to take advantage of these valuations and build a position for the longer term. This is where the growth is going to come from, but it's not going to be even, and in some cases there will be an inflation problem associated with that growth. You want to avoid those countries. You really want to go for those countries where the trade-off between growth and inflation is in a better balance.
But those comments and the regions and the assets that you're referring to would typically, traditionally, probably be seen not as defensive by degree. In terms of the defensive side of portfolios currently today, we know the issues with bonds. Is credit? How do we place the credit risk in those situations?
Well, again, if you go back to the 1930s, and there are very strong similarities, I think, between then and now, you actually found that some of the safer investments were in companies, not in governments, because you had currencies at risk, you had high currency volatility, you had governments that were defaulting, you had government debt that frankly wasn't being repaid in the returns that people had hoped for. This time around, I think you can look at some global companies and say, actually their credit rating is better than many governments. They are able to grow, more importantly, they're able to grow their dividend. So the fact that the starting dividend yield is higher than government bond yields, but also that that income is likely to grow, is a huge advantage for those. So actually I would say at the moment, they probably contain fewer risks than the comparison with many governments.
Which is why your advice and insight is so greatly appreciated. Thank you very much. Lovely to talk to you again, and I hope we'll be allowing you to take the economy apart and bring us up to date with your views at the time again, and not just in future. Thank you very much. Thank you.